this time around, yet again, there has been no surprise as the MPC has kept the repo rate unchanged for the 10th straight time on the trot at 6.5%. The stance has been changed to a neutral stance, with the FY25 GDP growth being maintained at 7.2%. The headline inflation, as the RBI governor declared, will moderate in Q4 of FY25, and the CPI forecast for FY25 has been maintained at 4.5%. There were also some additional announcements, of which I'm just going to highlight a few. That the RBI governor spoke of how NBFCs are aggressively pursuing growth while ignoring risk management, and it is important for the NBFCs to follow strong risk management. Let's connect with our guests. We've got Sachchidanand, Shukla, Group Chief Economist at L&T. We've got Mr. R. Gandhi, former RBI Deputy Governor, as well as Nilesh Shah, Managing Director at Kotak AMC. Thank you all, gentlemen, for taking time out. Mr. Gandhi, I want to get in your assessment first up. With the fact that it hasn't come as much of a surprise, do you think that this rate stance was the course of action the RBI Governor had to take, given the inflation, growth, dynamics, and the kind of tensions that we're facing across the globe as well?
Yeah, thank you. Good morning, everybody. Yes, the announcements were on expected lines. By and large, the market and everybody had kind of come to the conclusion there is not likely to be any rate change, but stance change will happen. And stance has happened now. Obviously, before moving into accommodation stage later on, when country would be wanting to grow much faster, the monetary policy will have to become accommodative stance it has to take. But before that, the neutral position is a warranted one. That indicates clearly that things are improving, and Reserve Bank is willing to once inflation is under its comfort level, then Reserve Bank will be focusing on growth prospects, so supporting growth prospects. That is an indication, underlying indication in shifting the stance from to neutral stance. That is what is important now. That is a very strong message. As again on expected lines only, there is no surprise about it, but it's the right direction. Only one surprise which has come out is that the inflation numbers for Q3 is likely to be higher than the earlier projected. That is something a little different. Looks like because of that assessment only, they did not go in for a rate cut, despite the last two numbers having been below Reserve Bank's target level, mid-target level. They remained conscious that in the very short term, inflation is likely to be a little up. That's it. Thank you.
I'd like to also encourage Mr. Nilesh Shah to join in. And just the first point which I want to perhaps throw at him is the clear mention of NBFCs. Nilesh bhai, so nice to have you back. First, let's get a reaction on credit policy, and then I'm coming right back to you for a reaction on NBFCs. Nilesh bhai.
So, the RBI, as expected, has changed the stance and probably laid the ground for rate cuts in the later part if inflation data comes as per expectation. We have been running a policy which is tighter on the fiscal side in terms of direction, not in absolute quantum, and a monetary policy which is also tighter, again from a directional point of view. Now, as fisc is becoming tighter, monetary policy will have to get relaxed a little bit. And that perfect coordination, equilibrium, seems to be happening with this monetary policy. Second thing, on the NBFC side, again, that is one sector where RBI has been cautious. It has increased risk weightage on unsecured loans. We hear from various commentary that microfinance loans are witnessing some pressure. Even some of the credit card debt has seen some amount of delays, not necessarily NPAs. Put together, RBI is proactive in its approach to give cautionary statement to NBFC sector, and I'm sure they'll be better off listening to the RBI.
One challenge for Indian economy has been that credit is not percolating through. NBFCs have been doing a great job of perhaps servicing the non-banked area. if there is a tighter regulation for NBFCs, do you think the end objective in a sense will get challenged?
So it's always a tough call. If you go on one extreme of providing credit to everyone, NPS will get built up. And we have seen that in post-global financial crisis cycle. On the other hand, if you starve credit to the economy, growth will get hampered. What is needed is equilibrium, a balance, a Lakshman Rekha, where everything falls in right space. And I think RBI has done a commendable job in taking proactive actions, whether it was related to unsecured loans, whether it was related to inflation, whether it was related to liquidity, which could have percolated into inflation. So I'm sure they know what they are doing, and NBFC sector will be better off listening to the RBI.
Mr. Shukla, very good morning to you. Thank you so much for joining us. Let's talk about the entire change in stance. No doubt the change in stance, it was a unanimous vote coming in from all the MPC members where they all voted for a change in stance. While you talk about the rate decision, it was 5:1 with the recent addition in the MPC members. There's Nagesh Kumar is the one who actually voted for going ahead and taking that 25 basis rate cut. When do you think will the RBI blink when it comes to the rate cut now? Do you think now with the change in stance, can we expect it as soon as the end of this year?
Good morning, and thank you for having me. I think it's been 20 months roughly and 10 policy meetings, and the RBI has finally signaled a change in direction. Some people might interpret this as if the RBI does nothing on interest rates, it is actually tightening policy because higher for longer rates are going to have an impact on the economy in terms of growth, and it will cost certain segments of the economy. The other way to look at it is that doing nothing on rates is still doing a lot. And I belong to the latter camp. I think the RBI, whatever it's done today, is very, very rational and desirable because we need a resolute and patient monetary policy. And that is our window to macro stability and sustained growth in a very, very volatile world. Now, the RBI governor pointed out the congenial conditions where data and stars seem to be aligning. But he's also done a good thing in terms of not dropping calendar hints in terms of when or what he's likely to do on rates. And he's cited enough risks to keep it hedged, be it crude, be it the commodity prices, China or global conditions. So I think he's mentioned the right sort of things and caveats. And to my mind, if the data continues the way it is panning out on growth and inflation, and some of the event risks that he cited are indeed something that we need to be careful about. The impact of the Chinese stimulus on commodity prices, whatever is happening in the Gulf right now, and any, say, escalation in the conflict is something that can have an impact on crude. And also the US elections, mind you, are a big event risk. So I think he's bought some more time for the RBI to make that move. To my mind, that move can happen probably in December, most likely, and an outside chance that he might shift it to February, the latter policy, if some of these event risks are not very, very clear. Back to you.
Gandhi, one is this signaling with a rate cut. Second is ensuring that liquidity and other factors are at play which will ensure that the yield remains low. Do you think this credit policy has done enough signaling both in terms of what bond markets should expect and also where the liquidity measures are moving? So it will ensure that the credit cost goes lower. So it may not be an official rate cut, but unofficially you've set the tone for it. Mr. Gandhi, question for you, sir. Mr. Shukla, I'm coming right back to you.
Okay, thank you. Yes, the monetary policy operations vis-a-vis liquidity operation, there will be a subtle difference because liquidity operations are based on everyday movement, and everyday movement in the market, the RBI action could be determined or driven by what is happening in forex market, in GSEC market, and in general money market. So that way, there will be subtle difference between the overall approach that is a monetary policy, which is dictated by monetary policy, and day-to-day liquidity movement. So the general stance is that the watching out will have to be on the money market rates, because that is what will indicate the where is going to be subtle backdoor rate cut happening or not. So when the stance has moved to neutral, then obviously excess supply in the market, which earlier used to be absorbed by the Reserve Bank, that may not happen. That would mean that it will remain within the system. That would mean that there could be a reduction in the market yields that may be happening. So that is a way of testing the market by capability to bear the differences in yield. The Reserve Bank will be watching out. As I said, that it won't be focused only on the money market rates. It will also factor in the impact likely to emanate from the forex market and the debt market.
Mr. Shah, coming back to you, I just wanted to get your take on the fact that the GDP growth, the FY25 real GDP growth estimate that the RBI has retained at 7.2%, this at a time when you are actually seeing uncertainty globally with the geopolitical crisis. There is a slowdown when you talk about the manufacturing sector. Some part of the manufacturing sector, you are seeing some sort of a slowdown. Do you think that this would be a tall ask for 7.2% GDP growth rate? And also, if I could add in that, this time when RBI governor spoke in his speech, there's no mention of the stock market. Mr. Shah, this one is for you.
Market was underestimating growth. Some of the global institutions started FY24 growth at 6 handle, and eventually RBI proved to be right with 8 handle. This time also market and street has not learned from FY24 lesson. Street estimate is lower than 7% for FY25, and RBI has revalidated their above street estimate growth at 7.2% this year. I sincerely hope and pray that like last year, market will be wrong and RBI will be right. RBI has access to lots of data, and hence I believe they will be right. And market is also right in assuming little below RBI's estimate level of growth based on whatever data it has access. There are certain weak indicators emerging on Indian economy. For example, September income tax collection crashed by more than 30% on corporate side. Personal income tax was strong, but corporate income tax came down. The GST collection growth year on year is below nominal GDP growth. And we hear, thanks to rise in container freight rates and non-availability of container ships, export is impacted to some extent. Now, this may be temporary and it will get reversed soon, but I'm sure RBI is carefully watching all that data. Stock market, again, I'm sure RBI is keeping a watch. They may not talk about it, but I'm sure it will be on their radar, especially with all the global geopolitical uncertainty.
Mr. Shukla, closing comments from you. I know you have a hard stop, so I'll make this one the final question for you. At 7.2% growth, at a time when we are seeing a slowdown, let's say, in passenger vehicles, tax collections, impact of base effect, this RBI assumption of 7.2%, do you think it is something which is optimistic, realistic, or it is something which could get challenged? Last year's number got challenged on the upside, so no one is complaining. Do you think the reverse could happen looking at the realistic picture?
I would think looking at the recent softness, and also if you look at how data has been panning out globally, all the growth surprise indices are actually beginning to turn downwards. When we look at India, I mean, some of the high frequency data and some of those that Nilesh Bhai pointed out are beginning to show signs of softening. I would probably be looking at a 7-ish number. I do still think that the 7.2 is a tad optimistic given whatever data access we have and looking at the trends that we have. I do think but in the global context, the 7% number is good enough. But I would be very, very wary of some of the trends that are emerging globally and the global growth index surprises. I would be somewhere close to 6.8 to 7%, where most of the private forecasters are.
Mr. Gandhi, while we are talking about the CPI inflation, I'd like to draw your attention to the WPI. The WPI inflation is in and around 3% for about 2 quarters now. And for anybody who understands the economy, they would say that CPI could be a function of vegetable prices, oil prices, monsoon, base effect. CPI is the real deal to gauge the economy. So if CPI stays at 3%, isn't that an indirect indication of a slowdown which has already started, Mr. Gandhi?
See, CPI, whole price, WPI, wholesale price index, it basically relates to manufacturing, whereas economy as a whole, when we talk about growth, when we are talking about all segments, where it is agriculture, manufacturing, services, and all. So that's one difference we have to keep. Reading too much into WPI should be at a little bit caveat that is one segment alone, whereas we are talking about growth means across all segments. Number two, agriculture for the past 4 or 5 quarters, growth had been very, very moderate, not even moderate. It was less than expected. But in the going forward, because the monsoon has been quite above normal, reservoirs are very full, and the crop acreage cultivation has also, there is an improvement. That would mean that agriculture sector is going to have a robust growth in the coming quarters. So that is one positive development which we should keep in mind when we are talking about overall growth of the economy compared to the last 3-4 quarters. Manufacturing, yes, as you mentioned, the WPI could be read into the conclusion, not conclusion, by inference that there could be some slowing down in the manufacturing segment. Possibly that it might indicate that, but compensating that slowdown could be from agriculture and services. Services have been very robust, and the world, in any case, India has never been completely relying on export sector for its growth. That is only an icing on the cake type. So even if there is, but you may heard from governor saying that world trade is improving, that would mean that a normal part India should be enjoying only. So I don't foresee, unless the geopolitical situation worsens, trade is going to be impacted. I don't think so. So that would mean that the assumed slowdown in the manufacturing segment could be compensated by other developments. That is why the growth should still remain possible at some.
Devang Shah, who's joining us in this discussion. A very good morning to you, Devang, and just wanted to understand your take coming in on this MPC meet outcome. We have the change in the stance, however, the rates have been kept unchanged for now.
Yeah, so I think it was widely expected that RBI will not be doing anything on the monetary policy rates today. There was a divided camp between stance change and no stance change. So I think probably RBI is probably proactive here and started giving benefit or look across the growth inflation dynamics, and they've tilted a bit towards growth. Inflation, yes, though the governor continues to remain cautious. But our perspective is, if you look at the internal core inflation continue to remain below 4%, overall headline inflation, despite some rise in commodity prices for the next 12 months, will be around 4.3 to 4.4%. So from a market perspective, I think RBI policy will be taken positively. The stance change will start building in some bit of expectations of rate cuts from December. Our view is that we will expect at least 50 basis of rate cuts till March 2025. Also, the global trajectory on rates has been trending lower. So you've seen all central banks across, like last quarter, we have seen some 28 cuts all put together. So that also adds somewhat more pressure on relative pricing for our currency and rates. So from an overall perspective, I think bond market should take the policy positive, and we should see yields trending lower.
Markets are trading flat, NBFCs are down, banks are trading with a positive bias. Nilesh is smiling, Mr. Gandhi is feeling delighted, and everyone is saying, thank you, Governor. All you've done is that you've stated the obvious. But, Nilesh bhai, the elephant has become horse. He's changed the animal in the credit policy, right? And with horse, you gallop. With elephants, you walk.
But elephant doesn't walk backwards, and that is most important.
One day I'm sure it'll be tiger, because that's what we all deserve. Now with the population of tigers also stabilizing. All right, gentlemen, thank you very much for joining us. Great to have you on ET Now.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.